Hey yo, what up YouTube? Welcome to the Money Room. It's your boy Nam Diesel. With me I have my co-host here, I2B, and we're gonna be talking about the stock market. More specifically about what happened recently. Stock market has been on its way up nice and slow, gently, and we had, a crash, quote unquote, whatever you want to call it. And that's what we're gonna talk about today.
Right. We're talking about stock market. I love it. Now, I've always been a fan of the stock market. The only thing I'm not really a fan of is the daily hustle that goes into day trading. But as far as how the
I
stock
agree with
market
that.
works, I've been a fan of it. I've been a fan of investing in stock market. And as a matter of fact, in recent times, as I was telling you before we went live, I read, I think it was last year or 2 years ago, I read when he released it, Tony Robbins, Money Master the Game. Tony Robbins is not a stock market master, but he interviewed a bunch of people. That were,
Yeah, that's how he works. He likes to pick the brains of all he thinks are the smartest or the best financial investors, and he kind of goes through his own thing from there. So, but yeah,
yeah,
he knows what he's talking about if he says something, for the
right,
most
right,
part. Yeah.
right. So from that book, I've created my most recent mindset when it comes to the stock market. Um, or stock market, like Americans like to call it. Sorry, I said stock, like stocking. But anyway, yeah. So I've literally created, and then in recent times he released a book called Unshakable, and then in that book, I had actually decided that I would not be messing with mutual funds and things like that, or any vehicle that's not straightforward. Like anything that's extra sophisticated. I don't need to mess with it. If I have the ETFs, the index funds, and things like that, especially when the statistics is clearly saying that those things are doing better than a lot of those things.
What do you mean? You mind explaining what you mean by
So,
sophisticated?
so sophisticated simply means sophisticated is in the eyes of the beholder, me being the beholder right now.
That's what I'm asking.
Yeah. So if I can't, if it's way too far from a simple concept of business of buy and sell, demand and supply, my brain would tune it out instantly. That's just the way I function. Now there could be more. I've learned. I did play with stock options a lot in the past, and it was a deliberate interest that I created that made me go into learning the beta, the theta, the expiration dates, and the butterflies, and all those things. I was enjoying that at the time, and I had a lot more patience than I do these days. So that's how I was able to. But when it comes to hedge funds and certain investment vehicles, if it's beyond, okay, so for example, mutual funds, right? Mutual funds is pretty typical. That's where they invest most people's 401k. Is that correct?
Not necessarily, but I'll keep going.
Okay. Well, not necessarily, but if I'm saying mutual fund, I'm categorizing it together with 401k. I wouldn't know what they are because I've never really worked a regular day job. So I don't know. So maybe you can enlighten me on that. But anyway, when the guy broke it down in the book, those things underperform tremendously compared to just betting for America, betting in favor of America, like when it comes to the diamonds, right? Which pretty much tracks the Dow Jones, right? Betting on the ETF, what do you call it? The Qs, right? Nasdaq, that's tracking the Nasdaq, and then pretty much investing in spiders, right? uh, SPY, which pretty much tracks the S&P
S&P 500.
500, right? So if you invest in those things, I haven't really done my own work. So, but if you invest on it, he showed some data that showed those things outperformed most people's mutual funds, and of course, a bunch of people that are actually picking the stocks that they put in a lot of those funds are not necessarily they're not necessarily smarter than regular people, right? So they may have instruments, they may have computer programs and algorithms that they use to pick stuff, but ultimately, when it comes down to it, majority of them underperform as compared to those ETFs. So, so from that, with respect to, let me say, provided I do like a further investigation a little bit more, I was going to start putting some money dollar cost averaging into the spiders, Qs, and diamonds. Okay, so I was yet to get there when the whole cryptocurrency came, and I got familiar with cryptocurrency, and I was like, you know what, this is a little bit more upside here than and that's why I'm playing the cryptocurrency game right now. So, but with respect to that, we can still bet in the favor of America. According to the books, it's not a good idea to bet against America. So the fourth book, before you go in right here, the fourth book I'm reading right now, no, the third book I'm reading on it right now is from a guy called Ray Dalio. Ray Dalio did a video, a very popular video on YouTube called How Money Works. And it's the most simplest way that explains how money works, when it comes to the cycle between demand supply, between treasury bonds, and how it rotates back into gold, and how it rotates around the recession and the cycle of money over ages, right? So he's the guy that created that video. He just released a new book called The Principles, and I was just in the first chapter where he was talking about the history of the stock market, and why it was and the crash he encountered in 82. It literally went down, like lost all his money and stuff back in 82, 83 because he was betting against America. So the idea of betting against America, unless you're a professional trader and you're edging, of course, we're not talking about edging right now. We're just talking about just straight up buying stocks, right? It's not always a good idea to bet against America when it comes to history. So that's why I like the stock market. I like it for a long-term play. I do not, I still don't encourage an average person that I will probably expect that watches these videos to play the short-term trades unless that's what you want to do as a 9 to 5 job. I will still not encourage that any day. Plus, I believe that the most stable, sustainable money you're going to make always is going to be in learning a trade, learn a business trade itself. Which is simple buy and sell. Find something you're passionate about doing. But with respect to that, I want us to talk a little bit more.
All right.
About,
I'm gonna start. I'm gonna start with give myself a bit of a pat on the back. So on the 29th of January, I said to you guys, someone along have it right here. Oh, the stock market is looking bearish. This is a good time to sell. You have some gains. Take out your gains, right? And I said this on the 29th of January, 2018, right?
Right.
At this point, when I said this, the SPY, as we said, that tracks the S&P 500, which is just generally a general idea of how the market is performing. So 500's S&P 500. We were at 285. Now we've dropped down to 257 from 285. This is one of the biggest drops we've seen in a long time. So I'm not trying to pat myself on the back, but I got to pat myself on the back.
You should.
I call the biggest drop ever. So, and it's not just about betting against America here. It's not just about betting against America. It's also about taking your profits, which I told you guys, because most people investing in the stock market are trying to make money. So I'm not telling anyone to bet against America. That's what I'm saying. I don't still misconstrue stuff here. But if you are making investments, and these investments, like the drop we just had, pretty much will have erased all your gains, taking you to way back wherever you might have been last year. If you're lucky, you might want to take some profits. So I said, hey, we're looking bearish now. Take some profits. So you could take some profits at that time and, hedge against it. Now, when it comes to hedging, there are ways you could hedge. You can use options. You can use a put option to lock in your gains. So when the market drops that way, you also still hedged in there. And so you're actually making money while the market goes down. So as you're losing money in your stock portfolio, you're also making money on the options. So that's another thing. So that's part of why I gave you guys that call. So you could take out some money, sell, because guess what? The open of why you're playing the stock market game is not just to leave in the stock market forever. You want to also make gains. So when you hit a couple of highs, you feel like you made some decent return. You want to take some of those gains off or move it around, right? So that's that. So I'm done with that with that pat on the back part. Okay. But 7 days later, we're down over 10%. Over 10%. And this market run has been there for like the past, since 2016. We'll be steady climbing. And boom, came down. I called it in advance. All
right, cool. Now, that's a good one. Now, can you go into the details of why you felt like it was? I mean, you know, obvious, like you were saying in the last session. In hindsight, obviously, uh, can you go into the details of why you felt like it was gonna crash at the time?
You know, if I tell you, I have to kill you, so I can't tell you my
You can
secret.
kill me. I mean, you can kill me. It's okay. But maybe, but yeah, give us.
But nah, but you know, I'll give you a very simple one. If this is a simple
Make
one,
it simple. Don't go into.
I'm not going to give you all the details. I said, because if I tell you, I have to kill you. It's like now. But I'll give you a very simple indicator that shows why. And a part of, you know, what actually led to this recent sell-off we've seen is a couple of things. A big part of it has to do with the algorithmic trading. And when the robots that trade the stock market these days see some certain kind of signals or certain kind of drops or changes, they're going to create a massive sell-off faster than a human could sell. And those big chunks of volume and selling caused by the robot causes fear in the market. So you don't care what's causing the market to drop. But when you see the market dropping, at that point, people are scared and people start trying to take their money out. But you don't know what initially caused it. It might not have been a fundamental cause. It might not have been someone trying to take their money out because of gains or because of, say, for example, it might not be because something happened with the interest rates or whatever. It might be someone just taking, it was exactly due to the algorithmic trading. And this is the quantitative trading. This is like, for those people who don't know, this is when, you know, people use programs to actually trade on the stock market, and it's not being necessarily driven by human being fundamentally. Just certain patterns are seen in the stock market, and the algorithm goes ahead and buys and sells. So a massive volume of selling came, which caused fear in the market. At which point, when human reaction now comes in, people are like, "Oh, well, the market is dropping. The market is dropping. What I do to make some money?" And these are people like who did not get the heads up from me earlier, right? So people who do not know have seen this shit happen. So now it's like 2-3 days later, now start trying to take out that money. And because there's more panic and more fear in the market, because more panic and more fear in the market, it's like a, you know, it's like a vicious cycle, and the sell-off just keeps going on and on and on, right? So that's that's what's going on.
Because just about 2 weeks ago, there was a record high, wasn't it? A record high of about 26,000 on the Dow Jones, wasn't it? Like some few.
I mean, so that's the thing. The market has been going up for a long time, and every other week has been another high, another high, another high. It's been steady climbing, and you know the most recent high we made, I say on the spot, was on the 26th. When I called it out on the 29th. And the thing is, what happens is if you see, like, you know, the certain indicators you can obviously tell it's not 100%, but one simple one I think everyone should just look at. You look at the futures, because the futures how the futures performing. If the futures are looking, you know, like they're going bearish, is a sign, because the futures are being traded for the underlying, which is the stock itself or the market. That is a sign that, okay, things are looking bearish and whatnot. So that's a simple one I could just put out there. And, you know, if you do not know that already, you know, look at the futures market is a good indicator of what the market itself, the stock market, might be doing.
Right. All right. So I'm looking at on that day when it hit that 26,000. You're right. The thing has been going up and up and up, right? So if you recall, well, I've done some analysis in recent times, and we all know about the higher lows and higher lows and higher highs, right? So we've been having some higher highs and higher lows, right? But clearly on that day when it hit 26, it came down a few days later, and that could have been a good time to take the money out or take money out, and you know, but then you could be wrong, you know, by taking your money out. It could be because that's one of the mistakes that this guy said somebody made. He was giving an example of somebody who bought silver, and then the person bought silver, and then silver went to $10. This was way back.
Right.
Silver went. What is silver right now? God knows, right? but silver was $10, and then he took profit at $10. But then silver now took another run all the way to $40, and then it was biting himself like, whoa, like he just lost a lot of money.
And that's all good. And what I tell people like that is, you're better off making some money than crying about more money that you not make. As you see in the stock market, the graphic, see, it's been running up all this while. So if you're in the market and you're just a dumbass and you just bought it and you held it and you just let it go, you'll have been making money no matter what, right? So unless you're being super greedy, and that's why I also said, hey, take some gains. You don't have to sell everything. Take some gains. So at that point, even if you sell, you don't have to sell everything. You can sell 20%. You can sell whatever you want to sell, 50%. Take some gains to hedge yourself against the possible unknown that's about to come, right? Which is what we're experiencing right now. So if, for example, you sold 30% of your portfolio, right? You didn't sell all of them. At least you're not taking a big ass loss as you would be taking. You see what I'm saying? So take some gains. And now, if you took those gains out, you could actually use those gains to reinvest it at the low and buy and rally back up. You know what I mean? So that's what I'll say. Something like that.
All right. Let me see if I can. Okay. Let me go through some of the questions I have here now. What percentage? Okay, that's a massive percentage from 285. Let me see if I can open it up here. From 285 to 257, you said, right? That was a crash.
Yep.
Let me see here. All right. So one of the things.
From the time I called it. So when I called it was 285. The high was 286. So if you could count 286, a little bit higher. But I called it at 285.
Right. It is 257, and last time it was 257 was in. Well, that's last year, just in November.
Right.
Okay. So to me, I mean, correct me if I'm wrong here. So it sounds like that language will be more directed to people that are trying to do a short play, people that are trading on a short term.
No, what language are you referring to?
So long term, right? If you are invested in this, if I had my money in, and it was 257, right? And it was 257 in November, and I had my money in, and I dollar cost average. I'm playing the long term gain. That means I don't care about this money for another 10 years from now, minimum, right? That means it's not really of any benefit for me to take my money out just for this short term drop.
That's not true. And the thing is, even if you're playing the long term game, you don't have to dollar cost average. You don't have to put your money across every month. You could actually just buy and hold long term. So when I'm saying long term, you could have bought in 2014. You know, this has been running up for a while. You could have bought in 2016, and you've been experiencing gains all this while. And now you see, like between November, right? As I said, between November and now, the market even exponentially exploded up even higher than it was before, right? It exploded higher up. Then January came, exploded even higher up. So you can see the increments and how the acceleration, if you want to call it, of the gains have been. So from November through about a couple of days ago, a week ago, it actually exploded even higher than it was before. So you could have been in the market since 2016. Up until like a week ago, you have major gains. You could still have taken some out. That's what I meant.
Never mind. So never mind dollar cost averaging. Let's say I had my money in there since 2016, right?
Okay, there you go. Yeah.
Let's say I had my money in there since 2016, and this was a long-term play for me.
Right.
What benefit is it for me to take some money out over the past 2 months when it could still rally up right now, and it can rally all the way back to where it is for all we know, but maybe not, right? We don't know, right? Maybe some algorithms out there know, but I'm talking about a regular person right now, right? What benefit would it be to me if, even if I bought last week at 296 and I'm playing it long term, right? What benefit is it for me to take my money out, if not losing money into fees?
Well, I'll say this: the fees, first off, are not going to save that much in a drop like this, unless you were some kind of fucked up broker. The fees are not going to matter that much in a drop like this, because this is where you actually lose your money. And beyond that, I want to address. Let me address the last week. If you're buying last week, you definitely want to get out. If you bought it a little before, I'll say, yeah, you want to sell some. You don't have to sell all of it, but you want to sell some, even if you bought back in 2016, because now all the gains that you've made in the past, 3 months, which actually has been the most exponential part of the market's growth since November, you just lost it. You know what I'm saying? You just lost it.
Yeah, but you only lost it if you sell.
No, you just lost it because you don't know where it's going to go. Right now, at this point, we don't know where it's going, bro. You don't know where it's going.
Okay, is there a difference between losing value on the underlying asset and actually losing money?
It's what I'm saying. If you sold it, right? Like I said, if you sold it, you'll have sold it. So you didn't lose any. You didn't lose any money. You just made money. So no matter, you just made money. And
let's say
and what you could do is also buy it again at the low. You know what I'm saying?
I want to give you two scenarios. Okay.
All right. What's up?
Let's say I'm looking at the spiders right now. Okay. And as a matter of fact, why don't we do this to make this a little bit more interactive? Why don't we do this? I can still see you can still see me, but I can essentially go
pull it up.
Pull it up. Yep.
Share that screen. Share that bad boy.
Yep. You can see now, right?
Yep.
All right, cool. So as you can see here, let's say I bought this around what is all this? So we can use something for free. You have to pop up stuff. So as you can see here, right? This is January.
Mhm.
This is September last year. Okay,
Yep.
September last year. Let's say I bought here. That's the first scenario, and I bought here, and it was at 244, right? And it was
Yep.
rallying. I'm feeling good with myself. It's rallying. I'm rallying. It's feeling
Hmm.
good. I'm not making money yet, in my opinion. Okay, this could be semantics in words. Okay, maybe, but this is money in the market that's playing, right? And I go here and I go here, and I got to this day right here. What day was that you said it? Uh,
On the 29th.
January 29th. On January 29th, this thing dropped, right? On this day that you told me that there was going to be a sell-off. Maybe you have access to certain sophisticated situations, right? And I should have probably listened to you, right? And I didn't listen to you, right? But this could have been another. This could have been a drop from 286 to 282. Could have been another one of this, right? I don't know if I have, if I can use a pointer here that has color on it so you can see. But anyway, yeah, it could have been another one of this area around 2018 January, right, where it kind of slowed down a little bit, right? It could
But
have
it,
been
but
this one.
but it wasn't, was it?
Yeah, it wasn't obvious because we're looking back now, right?
No, we're not just looking back. Look at this chart here, right?
Mm-hmm.
Do you see anything else similar to that? Since say you're the guy who bought it here. Do you see
Uh-huh.
anything? Up to the point where I say, hey, watch
But it
out now.
where? Tell me exactly where. What day?
Stop from where you bought it. Say you bought it at 248 or whatever in
Right, right.
September.
Uh-huh.
Anyway, you could visibly see this chart right now. Do
Uh-huh.
you see any other drop like that one right there?
There is one here. There's no drop like this one that we're looking at over the
No,
past
no,
few
no, no,
days.
no. I
But
mean the 29th.
okay, so from 29th to the 31st, right? Those 2 days, there
Do
are
you see
drops.
do you see anything? Do you see any other drops like that in the past in the
All right,
chart we're looking at
so
right
let
now?
me see.
No, you don't, right? Exactly.
No, wait. 285, 282. There's a $3 drop on a $285 value, right?
Yeah.
Look at this drop from here, right? This is 266 to what is this? 262.
That's 2 different days. Do you see
I
what I'm
know,
saying?
I know.
It's not the same.
What I'm
It's not the
saying,
same.
what I'm saying is that it could have been a day like this. There's a drop here. You see this
No,
drop?
but that day, does that look like the one over there at all or not? It's not
Oh,
the same, right?
oh, like this massive gap in between. Is that what you're saying?
Exactly. You saw
Oh, the
that.
gap.
Exactly.
Okay. So
Yeah.
there's no gaps like that. Okay, but there is a gap here. It started. There's a rally here, but it was a gap. If you look here,
It's,
right? Look at
it's
this
not.
date
It's,
on,
right.
on September back here, right? There's a gap here, but then I guess people woke up on the following day and then start rallying again, right?
Hardly. It's hardly a gap compared to that one.
Hardly. Let me see if I can. Let's see this. I don't know how to use this thing yet. I need to figure out how to use it so I can zoom in on it. Uh oh. See, it's so messy. I wish I could use. You know what? My think of swim is probably dead by now. All right, so
Well, yeah, you get my point. So anyway, so what's your point? Say if you're
all
that
right.
guy,
So my point is that if I was that guy and I
you
bought
bought
it,
in September.
I bought it over here and it rallied all the way here. Let's say,
Yeah, so I'll answer your question now. So if you bought it right here, right, and it rallied all the way up there, and I warned you over here,
right.
all you have to do is think of the fact that most of your gains, right? Think about where it is now. You just lost most of your gains, and that's exactly why. That's exactly why you should be concerned because
So losing gains, my point
is that most of your gains.
My point is that losing gains.
That's not the objective here. You want to make gains and keep them.
No,
lose them.
the objective. So again, thank you for saying that. Actually, the objective is actually on. That has a time frame on it, and it's long term. Okay, it's not a short term. I need to go in and go out. Okay, that's not the objective.
It's not short term. It's not short term, and I'm not saying it's short term. I know this guy's objective is long term. But even if your objective is long term, would you not get there faster if you don't lose all your gains? Because you literally just
maybe not necessarily.
No, necessarily you will, because you literally just erase all your gains and you're starting up again. So you might as well have bought it right here in November instead of buying in September, because all your gains.
So if I bought in November, right? Let's use that, and then it rallied up in 2 months, and then it crashed back to the same value. So
right.
So my question is So
my question is, are you trying to make money or are you trying to stay at the same spot?
No. So again, like you said earlier, the objective has a time frame on it. The objective is long term, not 2 months.
Long term,
about 2 months.
Long term or short term, We're not trying to lose money. You're trying to make money.
No, but the only time you lose money is when you actually sell. You don't lose money because the underlying asset drops in value, or because you lost the value that it has gained over the past 2 months. You're not losing if you don't sell.
If you invested your money in November, right, and by January your money's still the exact same amount, you're losing money to me.
Like you said, to you, but on a general grand
because that's the whole point of putting that vehicle. It's called an investment vehicle. You want to put it somewhere, and you want that vehicle to drive you somewhere, not be in the same spot.
Yeah, but there's also something called time frame. There's something in business called patience. There's also something called there's always going to be drops like this in any. If
you get caught in a drop, you get caught in a drop, and that's it. And at that point, it's hindsight. You got to figure it out. But if somebody like me comes up to you and gives you a warning, then it's your job to take the initiative or do some research to see whether they should take it or not. So that's my point. If you know that's coming, why are you gonna say so? If you know that's coming and you see the opportunity to sell, by all means sell. But if you're already caught in it, then yeah, then you're already caught in it. But the thing is, any logically thinking human being who would actually do one or the other will obviously rather sell right here at the top than hold here at the bottom.
Okay, that's where I'm calling your bluff, because this is not logic. This is not exactly logic. And I keep saying that on every conversation we have. There is time frames and there's ups and downs in everything we do in life and business. And sometimes playing that game is not going to be a straightforward math, like logical, like it's up there, obviously sell up there.
Yeah, you're not understanding what I'm saying. What I'm saying is this: say you invested the money in November, right? And right. I can't you give you as an example. I gave you a heads up. But say someone invests money in November and they know this is exactly what's gonna happen. You know this is exactly what's gonna happen. Are you gonna write it out, or are you gonna sell at the top and buy at the bottom?
Okay, so good question.
Are you gonna sell it or buy at the bottom?
If I knew this was exactly what was gonna happen, right? I would be playing the short-term game.
You do it differently. Exactly. So that's my point. So if somebody does not know and they get caught, that's one thing. But if you get heads up, then obviously you should care.
Yeah, but you have to understand.
You're asking me why should you care, and I'm telling you this is exactly why you should care.
Good. How many forums are out here where they give you heads up all the time?
I don't know. I'm not part of those forums. I give myself my own heads up.
Well, it's a lot.
Anybody could say anything, right? But the point is, there's a reason for it. Right now, it's hindsight. But what you're asking me
right now,
why should they care? I'm telling you why they should care, because they were given a heads up right there before it came down. That's why they should care.
All right,
that's why.
So
you
again,
hindsight. You lost all your money when you have to lose it. That's why you should care.
No, this is not enough. Just one scenario is not enough, because again, I can zoom in and out of this graph, and and we can see a lot of catastrophic drops.
Go ahead.
Right?
Go ahead and zoom out. Show me one like this.
Look at the graph. Do you see any?
2009. Is that what you'll show me?
Yeah, I was actually going to go back to 1931 because I just told you I could zoom out.
Exactly. So my point is, what you're trying to tell me is, if we're about to be in 2009 right now, do you want to sell or do you want to play your long-term game? Because even 2009,
but this is not 2009. Clearly,
how do you know that? Okay. How do you know that?
Since 2009, since 2009, good question. Since 2009, okay, I'm trying to use and I'm trying to make sure that we get to okay. So if we go back to 2009, right? Let's say I bought at the bottom 2009, and it's been rallying up right now. Have we seen quite a few scary moments since 2009? Let's
not use that. Let's use this as an example. How about this? How about it's been rallying up like it was before 2009? Right, someone gives you a heads up right here towards the top, right with the peak right before 2008, right, and they give you a heads up, hey, things might go south, and you say, oh, you know, no, I don't give a shit, I'm playing for the long term, and the market drops down, and it comes over here, say, oh, I'm still playing for the long term, then you get all the way down here. It took you 3 years, maybe even 4 years to even recover your money, and you're telling me why should you care? This is why you should care.
Speaking of hindsight, do you think we're back in
so this is exactly why you should care. This is exactly why you should care. The reason why you should care is because if you already, unless you're just being greedy, if you already made substantial gains, you can sell some and hold it up. You
that language, that's short-term trades.
No, it's not. It's not. It's just about rebalancing. And worst case scenario, if for example you sell and the market is still going up, it's not the end of the world. You just move it to another investment that's moving up, and you keep it going.
Well, here's what I'm going to say.
I'm saying.
Uh, again, I still have quite a few questions for you on this. Continue. Please sign up to continue. Oh, okay. I guess we have to sign up to continue, right?
Try freestockcharts.com. I think they
Free,
have something similar.
free what?
Just go with freestockcharts.com. I think it's something like that.
Free stock charts.
Yeah.
Okay, like this one. Okay. All right.
There's other one. Now go back. That looks like an ad. That looks like it's an ad, like Google ad.
No, yeah, it was a Google ad.
Yeah, go to the. I don't like using those ones because they're not real. Go to one below it or something. There you go.
Okay, this one. And run free version, right? All right.
There you go.
Everybody can see how we're getting this. Cool. Google has all the answers. Now it's telling me that I have to use something else. Oh God.
Use a different Explorer.
Yeah, I don't have no Explorer.
Sometimes they need to have like some kind of flash drive or something, some kind of flash so the chart works.
This was spiders, right? Was it S&P or just spiders?
Spy.
Okay, so it was this. Okay,
it's close enough. Yeah.
Let's just use this. Yeah, and I'm looking at the. I'm going to look at the max. Okay, and I'm going to actually click. I think I click over into it. I guess. 5 max. 5.
So now the other thing I want to tell people out there is, so now if you listen to Uncle Nam Diesel when they tell you to sell and you're smart enough, good. That's the first step. The next step is the other ways you could actually make money when the money goes down. There are also ways you could hedge your portfolio, like I mentioned, which is you buy a put option. A put option is basically a financial instrument that helps you bet that the market is going to come down. So what you're doing essentially is while you have your stocks that's still in there. So in this case, you don't necessarily have to sell. What you do is you buy a put for that stock. And so let me give you an example. Say your stock is at $100. Right. You buy a put option with a strike price of $100. What that means that when your stock does come down, even though you're losing money in your stock, say it goes from $100 to $90, you're going to make money back in your put option, a $10 spread. So it goes from 100 to 90. So that's how the put works. That's for betting the market is going to come down. You also have call options. The call option is you bet the market is going to go up. So say you see a stock is at $90 and you expect the stock to go up, and its strike price is $90. You buy a call option that with a strike price of $90, and this is a very simplistic version I'm giving you because there are many other variables that go into this. But if it moves up, from the stock goes from $90 to $100, then you just made $10 spread. So these are ways you could do things you could do to or instruments you could invest in to help you hedge against these kind of scenarios where you're unsure of how the market is going to perform. Now you can actually combine the two. You can have what you call a straddle. Now, say for example where the market is right now. Okay, you don't know if it's going up, you don't know if it's going down. So you might want to actually buy a straddle. And what that means, you want to buy a call option, you want to buy a put option. It could be at the same strike price. The strike price could be where the market is currently, say 240 or something. Buy a straddle, 240. So what that might mean now the risk is if the market does not move out of a certain range, say it doesn't move from between 230 at the bottom and 250 at the top, you might end up losing your money on the options that you just bought. That's the risk that you take. But what you're betting is that within a certain time frame, say 5 months, 6 months, a year, whatever time frame you buy the options for, because they're different options and different chains, then you start to make money. So say for example, I buy that strut I told you, for example, and the market is within 230 and 250 for a while, I'm still not making money. Well, the moment that the market breaks out of 240 going up or breaks below 230 going down, because I'm not sure, I don't know where it's gonna go. I don't know what call to make, quote unquote, right? Then you start making money. So say the market breaks through and goes up to $300, I just made a shit ton of money. Or say it crashes down, it goes below 230, I just made a shit ton of money too. These are the kind of things you got to think about because you want to make money regardless of where the market moves.
Let me ask you a question.
Nambi told you. Nam Diesel.
Let me ask you a question. And you know, I just want us to, if we're going to tell people that we can make this kind of predictions, right? I also want us to show them, you know, over time, we definitely want to do like this kind of additions, right? Like I would like to be able to make this kind of call ahead of time on an edition of this of the Money Room, right? And then watch.
I know you like to be able to do that, wouldn't you?
Well, it would be nicer because then it's a lot more reliable, especially if we have a few more scenarios like this. You know what I mean? And also, I would like to also find maybe a common ground in terms of defining what a short-term and a long-term play is, right? I think I agree with you, but I think we're off a little bit on agreement on what a short-term and a long-term play is.
So just in general, it will depend on a couple of things. So you have people who do day trading, meaning that you want to trade within the day. You want to get out of all your positions within that day. That is very, very short term. That's day trading. You could get even more short term than that. You have high frequency traders. And what you're doing is you're trading minute by minute, second by second, using algorithms. So there are different levels of this. You can also go to momentum guys who also want to trade a couple, within a couple of weeks. So the terms vary. But if you want to go like as far as like say quote unquote what you want to call like a long term trader, generally you're holding a position for over a year because that way you're not paying capital gains. So if you're considered a long term trader, traditionally, more than likely, if you're holding your positions for over a year, then you're seen more as a long term trader. But now you can also trade your strategies for over a year. You can get really technical about it, but for the most part, when you think of really long term, you're talking about over a year, especially for tax purposes too.
All right, perfect. So now, if we're talking long term, again, I was under the impression that we will be talking to more long term traders, but it looks like we're talking to people that actually want to watch for the right time to come in and the right time to get out. Right? Correct?
I'm talking to everybody peer right now because right now. So you might be quote unquote a long term trader. You might be doing long term trades, but at the same time, you might also be doing short term trades. Like you could be doing more than one. So there's not so even though you could have a long term trading strategy, that does not rule you out from getting in and out. You know what I'm saying? That you don't have to have only one strategy. You can have multiple strategies and use them. So the same people we're talking to that this may apply to.
So that's what I meant.
Also not apply to. So you could have multiple strategies. Doesn't mean that you have to fit in one bucket and one bucket only.
That's what I meant. Do whatever you want to do. That's what I meant earlier by, again, if somebody is going to have to watch their stock market, you have to understand that there are people out here, someone like me, I don't want to go in and I don't want to hear this mouth that it's time to get out right now. If I'm playing long term, right, I'm saying, I'm not looking at this until my day of exit strategy. For that particular play, you know what I mean?
I'll tell you this, even if you're playing long term, even if you're playing long term, you still want to hear my mouth. Even if you play long term, short term, you still want to hit my mouth. You want to. It's for your own good.
There's a type of person, right? As a matter of fact, let me stop the screen right now. There's a type of person, right, that's sitting on the forums, on WhatsApp groups, and talking about this all day long, right? And kudos to them. And beautiful. They would love to hear from Nnamdi. Okay, what do you think right now? Is this the right time to get in? What is stock market saying? Nnamdi, am I safe? I just had some gains, so should I get out? Oh, no, it's okay. Chill, right? There's some type of people like that. There's some type of people that say, I don't got no time to look at this stuff. I don't want to look at this stuff for another 3 months, another 6 months, right? There's some type of people like that. And I would like to categorize myself as one of those kind of people, right? I'd rather play the game where I can just sleep at night. I don't want to wake up to this kind of stuff and it's bothering me. Like if I woke up to this and my exit strategy was in 3 years from now, this wouldn't bother me. It's just money that I didn't sell, so I didn't lose money, essentially. And remember that I got in November, so it doesn't really matter that it lost all these gains since November. It really doesn't matter because it can gain all those gains. It can gain all that plus 3 more in the next 2 days, right?
I think it might, or it could keep tanking down.
I'm telling you I'm telling you.
I know, but I'm saying it should matter to you. It should matter to anybody, even if you're playing long term.
So tell me why it should
the only way I'll say, like, certain ways you could do this. You could, strategize yourself to be in that position. And it's all about having your stop loss. If you're comfortable with your trading strategies, you have your stop loss, so you have a trailing stop loss and stuff like that. So it means that, okay, if you lose money and you get stopped out, you don't really care. So you have a stop loss set in place. But at the end of the day, it's good to be aware. I'm not saying that you have to be minute by minute on the dime, everything that's happening. You don't necessarily need to be that way. But if you want to sit back and relax and not really care about it, and you're not seeking alpha that much, then what you need to do is have a certain kind of strategy that if things move against you, you get stopped out, or else you can lose all your gains. Say, for example, I'm not looking for 6 months. You're not paying attention to the news. You know nothing that's going on, and you have no stop loss strategy in place, and you say, the market is going up. Let me give infinite. And this is 2008, because that's how a lot of people got caught. They got caught that way. And it's saying like, okay, they're not thinking about anything long term. They probably heard someone talk. The market went down today. Like, yeah, I don't care. I'm playing long term. If you don't have certain things set in place to hedge you against that kind of risk, you could lose all your money. And people lost a shit ton of money.
Let's assume I know what a stop loss is. Let's just assume I know what a stop loss is, right? But I said, fuck that, right? And I don't care about those terminologies, right? And I said,
then that's not good. Then that's not good.
So again, that's why I want you to come to my side here and hear me out first, okay? Because again, once you start using terminologies like stop loss, put options, because even before I talk about put option, I would like to actually define what an option is, because option.
I already explained that. I already explained that.
You didn't define option. You just defined put option. You assume that I know
I,
what option is.
I don't want to just say option. If I say option, it means nothing. But if I tell you what a call option is, what a put option means, then it makes sense. Option in general is just like is air. It's nothing.
Well, that's
a call option is very different from a put option. So
let me. Since we're talking about that, let me. Option is this, because we're using real estate, right? Option is like, give me an option to buy this house next week at $250,000, even if it's worth $300,000 on that same day. Just put it in writing right now. Give me an option to buy at $250,000, right? So no matter what happens, even if it goes up to $300,000 next week, right, you are obligated to sell the house to me for $250,000. I can now turn around and sell that option for 25 grand, okay, to somebody else who now see, wow, this is a bargain, right? It's a $300,000 house. I get to buy it for $275,000. That's the basic definition of what an option is, and that's me playing. And that basic definition is pretty much defining call options. Okay,
that makes sense. That makes sense to me, but I think that might confuse a lot of people unless they're playing both the real estate and the stock market game. Some people,
that's the time. The key thing there is,
people don't know about real estate will be confused by that. But at the end of the day, an option is a contract. An option is a contract.
Let's spend 2 minutes on it. Let's spend 2 minutes on it.
I don't want to waste too much time, but I give a simple example. An option is a contract that covers a stock, for example. I say, for example, I buy a call option. There are two types of options, right? I'm not going to get into the details of European option, American option, but there are two kinds of options. You have call options, and you have put options.
What is option by itself first?
Hold on. We have call options and we have put options. A call option is what you take when you're feeling bullish about the market. If you feel the market is going to go up. A put option is in general what you take when you buy if you're feeling bearish about the market because you think the market is going to go down. So now, say for example, because I like to give you examples, real life examples. I could give you a definition. I say contract, blah 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 blah, but will mean absolutely nothing to you unless you've dealt with them before. So now, this is how you use a call option. If a stock is currently $100, right, and I see a call option for simplicity at $100 as well, and I'm thinking in my mind, I have a speculation. Because you can use it to hedge too, but I'm using speculation as an example. So it's very easy. That this stock is going to move from $100 to $110. If I buy that call option, right? That's the same call option on the strike price of $100. I'm going to gain the same profits, right? In the simplistic level, I'm going to gain the same profits as I would if I held on to the stock from $100 to $110. Let's capture the $10 margin. And that $10 margin, if it's for 100 shares, is $1,000. That's an example. Now, if I did a put option, it was the opposite, and I'm thinking, okay, this stock is currently $100. I'm expecting it to trade down to $90. If I buy a put option on the strike price of $100 and it moves down to $90 from $100, I just capture the $10 profit again, $10 margin, which would be the same thing out of that if I short sold that stock at $100, and that's $10 spread with 100 shares and $1,000. Okay, that's a simple example of a call option.
You're betting on the margin. You're betting on the margin?
Yeah, you're betting on the underlying. When I say underlying, I'm referring to the stock. You're betting on what the stock is going to do. So is it going to move up or is it going to go down?
Yeah, but isn't that exactly what you're doing when you buy the stock? What's the difference between that and just buying the stock?
That's exactly. So now what I'm trying to say here is that's why you're buying an option. The option is a contract. I said earlier, the option is a contract. So a put option is a contract, and so is a call option. They're both two different forms of contract. One contract is telling you that it's going to go up. The other contract you're betting is going to go down.
Okay.
And now to add a couple of layers, I don't get into more detail, but they have times of expiration. So now it could be 1 month, it could be 2 months, it could be 3 months, it could be a year. But just logically, right? If I don't have a contract that's going to expire in 1 year versus a contract that's going to expire in 1 month, which is going to cost you more money? Obviously, the one in 1 year because it gives you more time. So you're also paying for that time, and so on.
So you would agree that there's no such thing as an option without a time expiration on it, correct?
Of course, there's always there's always time expiration on every option.
All right, great. So I just want to make sure I nail that. We've agreed it's a contract to buy at a certain price with the time expiration on it, right? That's what an option is, right? So now if I know it now, okay? Now that I know it, I can use it to bet on a speculation that it's going to go up or it's going to go down, and that can help me edge against the market, right?
Exactly.
So now I have to have a TD Ameritrade. I say America Trade, TD Ameritrade platform, or Thinkorswim, or some kind of platform where I can buy and sell these things, right? Exactly. We want to agree we're talking to that audience, not people that I just want to take part of this long term?
I want to talk to everybody. So I'll break it down to
Okay.
nitty gritty for people who understand, and for the people who are a little bit more advanced, I'll talk on that level so they get what I'm saying. So I think I've covered all aspects from explain what an option is, and those who already know what an option is, I'll show you, hey, this is how you can use it to hedge your portfolio if things are going down. And as a matter of fact, this is how you can also use it if you don't know where the market is going. It could go up and down. This is how you could use both of them and so on. And there are many other strategies, but I'll leave it as that today as far as options.
Now, our option would typically cost a little bit lower. One option, one contract for one share will typically cost a lot lower than what it would cost if you bought the stock itself, the underlying asset.
Exactly. And the reason for that again is because options have a time of expiration, unlike the stock.
Time expiration, and it's just a volatile contract that can expire into thin air. It can disappear, it can vanish because of the time expiration.
Yeah, so once the time of expiration is done and the contract is over, so a contract is only good for the time that is given. After that, it's gone. But the underlying itself, which is the stock, is obviously going to be good for as long as the stock exists. So for that reason, you're going to probably pay more logically, and that's why I set up that way. You pay more for a stock than you will pay for the option. But the option does have the risk that's going to go away, right? And that's the risk they take with the option.
Right. Now, looking at that graph that we're looking at earlier, it looks a little scarier, but not exactly. When you look at that graph, it's in the upward, but it depends on what timing you came in too. If you came in at the edge of 2017, you probably are doomed by 2 years later, right? and you're like, okay, what happened, right? This was supposed to always be going up. But the truth of the matter, I think what anybody can take away from this edition is that it's not always going to go up. And one of the things I always try to teach people about business is that you could get caught in the right time, in the wrong timing. So you always want to know, you definitely want to listen to what Nnamdi is saying with regards to timing. So you got to have some kind of resources to know how to, see what's going on as far as timing in the marketplace and know when you're coming in and coming out. And you want to define discreetly what long term and what short term is to you as an individual. Would you agree to that?
I mean, I think most importantly, what I want people to do is figure out what strategy works best for you. It doesn't have to be long term or short term. You can actually play both. So I feel like a lot of people get stuck in a certain mindset. Oh, I'm a day trader. All I'm going to do is day trade. Oh, I'm a long term guy. I'm going to do is long term. You don't have to do one. You're going to have to force yourself to fit in any kind of bucket. You're limitless and do whatever works best for you. If day trade is making you the most money and that's fine, that works for you, that's fine. You could do that, but you can also do something else to supplement it. It's all good. Well, do whatever works for you. Find a strategy that fits and go with that. And obviously, long term and short term, I guess the disadvantage you can have in short-term trading is you have a lot more fees because you're going in and out. But you also have the advantage of taking advantage of the volatility of the market itself. So when it goes down, you sell, you buy. So you have the advantage too of if you're playing short-term. So the point I'm trying to get to is, depending on who your broker's firm is, you have to consider your fees and how much you're paying. If you're paying high premiums, then it's very likely, or high fees, it's very likely that you want to play long-term, right? And if you want to be going in and out, you probably want to be with a broker who, like say Interactive Brokers, for example, or a broker that's going to give you less fees, so you could, play the game that way. So that's my 2 cents.
So I'm your new client. I'm your new client now, and I got $1 million to invest. I'm not downloading those stupid apps so I can be edging it. In fact, I don't care about your put option, call option, whatever right now, right? And
I'll tell you first off, as a new client, you have $1 million, whatever, you should care. You should care, or your $1 million will go away.
Well, I care enough to keep it under the pillow if you don't tell me something nice right now and why I should invest with you. You've just shown me that you predicted 7 days ago that it was going to tank, and then it tanked. That's not good enough for me. I need more reasons why I should invest my money with you, and you just try to sell me on I need to learn call option and put options, and I need to short-term trade in my definition. I
never say anyone needs to.
You said I need to add it to my strategies.
That's not what I said. I said don't force yourself to fit any bucket. If you like short-term trading and that works for you,
well, I'm telling you my bucket now.
If you could do long-term trading, do it too. I'm not saying that you should force yourself. If it's long-term that you're doing, and keep doing long-term. But I'm saying, but don't force yourself and say, okay,
are you saying
long-term? I don't have to know anything else. You could do other things too.
Are you saying long-term fits my criteria based on what I'm saying so far?
If you don't want to do any kind of trading in between days and here on weeks, then yeah, that's not like your long-term guy.
I don't want to see this. I like the idea of stock market. I read those books, and those books seems intriguing to me. But I still need your help, Nnamdi. But you're telling me that I'm gonna have to sell sometimes and download an app, and when you tell me, first of all, I need to be on the WhatsApp group and see it, because I'm too busy. I won't see it. I won't see it when you tell me to sell. And this is real, by the way. This is real, by the way, because actually when you said that some 7 days ago, and I think I see traces of you saying something like that, but I wasn't exactly paying attention. And let's go back to my person right now, my pretend person, right? So I wasn't paying attention. But still not good enough, because I've seen quite, even though you're telling me that it doesn't look alike, but they look alike to me on that graph. I've seen quite a few days that there was a sell-off like that.
We just looked at it and it did not look alike. And the only one that you saw up there when you went far back enough was 2009. I was like, that's not where you want to be.
No, that's not the same thing. I'm talking about
if you can pull it back up then, because we just looked at it and we did not see it.
I will not if you keep arguing with me, Namdi, I will not give you my $1 million. Okay, so
that's fine. That's fine.
Relax. Okay, so since that bottom in 2009 is what I'm talking about. Since that bottom in 2009, I saw quite a few similar sell-offs since 2009. Why should I have to sell when the trend has shown over the past 8 years that it's been going up and up? Why should I sell since the trend, again, I'm playing a 5 years game here, right? And the trend has shown me, let's see here. Wait. What's wrong with this thing? Oh, this thing is trying to force me to sign up. The trend is showing me that, the thing has been going up since 2009. So if I had this,
I want us to talk with facts. So if I'm talking to somebody who's trying to give me that money because it's burning a hole in their pocket, I'll first tell them, hey, I don't need your money, but if you want me to help you, I can help you. I'm talking with facts. So now let me see what you're talking about.
I'll be like, fuck you, I want to give you my money. So tell me why tell me why I should give. I want to give you my money, but I need you to tell me why, because I'm not getting you off this line unless you tell me why I need to give you this 1 million. I saw quite a few sell-offs since 2009. Why should the last 7 days? I just showed you.
No, show me. You're not showing me. You're not showing me. What you showed me before, we both agreed, and you could play this back if you want to. We both agreed that was not what I showed you on the 29th. So if you could go back to 2009 and show me something, I'll show you exactly why that's different or why that might not be applicable to right now.
Okay, so I got my app in front of me right now. Let's just screen. The thing. I'm just gonna. It just crashed from 285 to 250, right? 285, 250, 285 minus 250, 35 over 285. So we just added 12% sell-off, correct?
Right, 12%. That's fair.
So we haven't had a 12% sell-off since 2009. Is that what you're trying to tell me?
12% sell-off. How many days are you referring to? You know what I'm saying? You can't say 12% sell-off. You have to consider how many days did this sell-off happen. Was it in 1 day? Was it in 7 days? Was it in a whole year? Was it in a month? Was it in 5 months? You can't just use. That's what I'm saying. Show me
within 7 days. Your point was 7 days. Within 7 days, we haven't had a 12% sell-off since 2009.
Since 2009. 2009 yes. is when they had the crash.
No, 2009 is the bottom of the crash. Is the bottom.
Yes. So are you trying to tell me that you perfectly came in at the bottom of 2009, which never happens because most people don't always buy the bottom. But you perfectly came in, you bought the bottom somehow, and you've been riding it all the way.
Yes.
You're just trying to give me an ideal way.
That's the ideal scenario I'm giving you right now. And
you're just having to buy the bottom.
And I've had some scares.
Let me pull up my graph real quick.
No, I'm actually going to share. I think I got it back up again.
Oh, you got it now. Okay, good.
So, and this graph is looking to me. It's where I've been. Okay, so we're going back to 2009. Okay, so 2000. Okay, as a matter of fact, in 2016 there was a crazy sell-off over days here. Do you see this?
Hold on, come on.
Oh, okay. So that's actually spiders. Let's go to.
Yeah, keep on the spy. Yeah, what's up? What you got?
Okay, so you see this? This was 2016. Do you see this craziness here? Are you saying if I bought here and it crashed because Nnamdi told me over here, what tells me that we're still not gonna rally over the next 1 year? This was 2016.
Zoom out some more for me.
I'm gonna take hide for now, and I'm gonna take a screenshot of this once and for all, since this thing is acting up. Let's see. Sorry. All right. So after this, I may not be able to zoom out, but let me zoom out a little bit.
I'll pull it up on mine then. Let me see what I have here. 1 second.
All right. So do you see this now? Okay, I'm zooming in. I'm actually glad we went a little deeper into this because this guy, you want more $1 million, and you're trying to take away too quick. No takeaways over here, bro. There's a sell-off here in 2010. There's one here in 2011. There's another one here in 2012.
Okay.
That's quite a few sell-offs here, man. Can you see that?
Yeah, and that's why I said show me so I can tell you, because you can talk about things that I would say that you can talk about things that
So
make no sense. But I'll tell you why.
I would have lost money because I was panicking.
I'll tell you why. First off, if you go back to 2010, right, or 2009, where everything started rallying up, right? You can see if you look at 2006, so right above 2006, you had like a high right there, right? 2000 was that 2000? Sorry, 2008. You had a high right there,
that was
right?
a crash. That was a crash.
Right.
Okay, so okay. I bought anytime during 2009.
I'm getting somewhere. Let me tell you. I'm telling you. You want me to tell you why? Listen, and I'm about to tell you why. If you don't listen, I can't tell you. I can't deal with clients that just like to talk. Listen, okay? So now that's what I'm trying to tell you. See over here at the bottom, right? At this point, if you're in 2009, if you look at exactly where 2009 on your graph down there, you can see that if you look to your left, this is the bottom, meaning that there was a high before that, meaning that the market has tasted this high before. The market has been like, oh, this feels good. This high on my left feels good. The market has actually tasted that before.
Right.
So at this point, in 2009, when you're having all this mini crashes you're having over here, this mini crash even call or the only mini crash you have, I could say, is one here in 2010, right? And one here in 2011. At this point, you still have not hit the high that we had from 2008.
Right.
Correct?
Right.
So that's what makes this very different. This is not a new high. All these are not new highs. It's dropping down, but it's still trying to move back to where it was previously. Right?
Okay,
and eventually,
so we can go to 2013 then, because it hit that high.
And eventually it did in 2013, right? Eventually it did in 2013. So now from 2013 onwards, all right? As we're going up here,
right?
You can see now from here going forward. Now at this point, you're in territory where you're making new highs. Every so often there's a new high. There's a new high. There's a new high. There's a new high.
They don't all look like new highs, and I'm going to zoom out right now. They don't all look like new highs.
It's obviously new highs.
Obviously, you're right. But I'm saying, if we're in that time frame, there's some of them that they were sell-offs. Like this one right here. Around here, there's a sell-off right there. And I can zoom. I'm zooming out, right? See the sell-off right here? This was November 2015. So are you saying that if I sold off here, I don't know how many days later, like a month later, I was back up here, right? And then another rally all the way, and then we have all this rally before today, right? So if I'm playing even a 1 year and I sold off that day, right? The only thing I did was just, okay, when is the right time to buy again? Okay, I guess I could buy now, okay? And I think a lot of people do too many frequent trades and lose money into fees, which is one of the things that
and that's why I said from the beginning. First off, find out what broker you have. If you have a broker that's charging you that much in fees for a drop like this, then you're with the wrong broker, my friend. You are with the wrong broker, because there's no way. If you're making, because based on this long term, you're making 10 trades a year at most. You're making 10 trades a year, and you're losing money on fees. You either one, don't have enough money invested, which is why it's all going in fees, or two, you're with the wrong damn broker, because it makes no sense why fees should matter that much if you're making just 10 trades a year.
All right, so that's going back to what I was saying earlier then, because let me take this off so we can switch faces back and forth as always. So the thing that I'm seeing here right now is what I notice is that if you have certain amount of money, yes, you can negotiate fees and they don't have to charge you. But if you're dealing with anything less than $100,000, you're just gonna pay regular fees like everybody else on regular exchanges on an app. That's what you're gonna pay. You don't have room to negotiate fees. So, and that's the more reason, the lower your money is, the more the fees is gonna eat you up if you don't know what you're doing with these trades. If you do too much frequent trades, it's gonna eat you up. And I feel I could be wrong, NMD, right? But I feel in my spirit that there's too many people making too many frequent trades that are not even looking at the math. They have that one nice win, and that's the only story they keep telling themselves. But in truth of reality is that they keep making so many trades, they're not even keeping track because they have to go back to the 9-to-5 job. They're not even keeping track of anything, but they're losing so much money, and they're still playing the same game 5-6 years. I know I have a few friends like that. 5-6 years, 7 years. later. There's nothing wrong with that. I'm just saying there's no fixing of that. You know, there's nothing wrong with making mistakes, but when there's no learning whatsoever to learn, there's a balance between short and trade long trades here. At the end of the day, you have to watch your fees. You have to watch if you're going to play more frequently, you really have to watch your fees, no matter what kind of broker you're playing with. Because if you were $1 million earner or something like that.
Let me ask you this, because you've been saying fees. Let me ask you this: how much do they charge you in your fees per trade, or how much do you think a broker would charge in it?
Enough for the house to keep making money from your.
No. Serious question. How much? How much do you think the average fee is for a broker for one trade?
I don't know. You tell me.
No, you tell me.
I haven't messed with stock in a long time. You tell me. But I
So,
know enough to keep people broke. I know enough for the house to keep making so much money from people that don't know what they're doing.
let me ask you this: if you have 100 shares of any stock and it moves up $1, how much money did you just make? If $1 move,
You have 100 stock.
100 shares.
How much is your shares?
How much is $1 move?
$1 move is $1 move.
Yeah, how much?
$100.
Exactly. So now, when we talk,
That's not a good enough number for me. What's the percentage? How much is the share?
I'll tell you exactly what the point I'm trying to get to. All those drops you saw in the chart you were just looking at, those are 10s, 20s, big chunks of dollar moves.
My point.
So if you're paying $10, and this is very, very high. I don't know what kind of broker would rob anything.
Aren't you paying fees per shares?
Hold on, let me finish. If you're paying $10, if you're paying $10 for buying some shares, right? And after paying $10, you make $200, $300, $2,000. Who gives a fucking shit about freaking fees if you're making just 10 trades per year?
Good question. And let me answer, okay?
If you're making 10 trades per year.
Good question. First of all, you're not making 10 trades per year.
Because you talk about a long-term guy. You say you give an example of a long-term guy. No one gives a shit.
If you're making 10 trades a year, that's not long-term. That's not.
You just told me that if you're trying to buy from 2000 and whatever 2009 or whatever stone age that was.
If I bought it in 2009
and hold it, that's one trade, and that's not even 10 a year. So 10 a year is on the higher side. So one
Right. So I was saying anybody who is doing 10 trades a year is not long term. That's my point.
No, you could be long term and buy 10 different stocks in a year and hold on to it. It makes no difference. You could be
absolutely per your definition, but that's not the definition I was talking about.
No. That's what I'm trying to say. No, you're misunderstanding what it means to be a long term trader. I could have 10 different stocks. I could buy Apple. I could buy Google. I could buy 10 different stocks, which is 10 different trades for the whole year. Because no matter if I'm long-term or short-term, I could still be long-term because I'm buying and holding. That's what I'm trying to tell you.
Okay, so here's what we're going to do to round this off. Okay, to round this off, here's what we're going to do. We need to work and find some really very nice case studies over the past, people that have been actually trading. Okay, I don't know if it's short or long, over the past 3 years or so. As long as they're willing, let's keep asking that question. As long as they're willing to share some information with us. And let's see who's winning doing this, okay? I'm not saying the long is going to win either, but if they haven't sold, they haven't lost either. But if you've sold something, somebody has lost something, right?
That's what we talk about is unrealized and realized P&L or profit. So if you tell me if you haven't sold, you haven't lost. You haven't sold, you've still lost. It's an unrealized loss. It's still a loss. So if you bought it somewhere and you haven't sold it, as of this moment,
why do you always act like you're the one that went to
if I show you, if I show me your books, it's still a loss.
Why you always acting like you don't want that went to
it's still a loss.
I know I didn't finish school, but still, P&L loss or not, I don't care.
You have to care. You have to care because that means you're losing freaking money. That's your money.
No,
you don't lose money. That's not the goal here.
But that took me completely out of what I'm saying. Saying
what I'm trying to say to you is this: your investment vehicle is to make your money. So if you're the mentality that I bought this stock in November,
and now time expiration on contracts.
And now I'm done. Hold on. If I bought something in November and now I'm down money, then that means you lost money. Whether you like it or not. And if you keep trying to see
it's not. When you tell somebody that, they panic, and that's what creates fear in the marketplace, and that's why the house always wins.
So what I've noticed, a lot of people hold on to their losses for too long, and they hold on to their good trades for too short. What I'm trying to say is, people have a good trade, right? And the trader moves like a little bit, and they sell it quickly, and they get out. And when they're losing their money, they keep holding on to that shit, and what that shit tank, and it drags down the rest of their portfolio. because they want to believe that, okay, I'm going to hold this for the long term.
Can I point something out to you?
And one day it's going to come back up. Instead of waiting for one day to come back up, get out of that shit, buy something else, and let your money move up.
Can I point something out to you?
Go ahead.
Back in 2008, when all of that happened, I was dead in the middle of the whole thing, okay? The subprime loan, all that craziness. I was dead in the middle of it, okay? Even without me checking the market every day, right? It was really, really cold everywhere. Like cold. Like you could feel it. You know something catastrophic is going to happen. I was in denial because, to be honest with you, I don't even know what recession meant at the time, okay? Because I'm like, you know, because I've never experienced it before. Like, what's that? Like, everything's just going to disappear. That's exactly what happened over the next 1 year after that, okay? But you could feel it in the marketplace. So right now, with that sell-off we just saw right now, okay, outside of having Trump in the office, right? Is there anything that we could feel out here in this marketplace that can make somebody who is playing at minimum a 1 year trade, right, that can make them panic like it's time for me to sell too? Or is there anything like that out there? Should we be scared? I'm asking you honestly. Should we be scared? Is there a big sell-off coming, or this is a short-term sell-off? Is this a short-term sell-off, or is a big scare coming?
What advice everybody else to do always have a hedge when you can, and have exit strategies. So even if you're playing long term, you still want to have hedges. You still want to have, especially if you're playing long term, you definitely want to have hedges because that's your game long term. And you want to have exit strategies of how you could get out of it. And beyond that, as far as what it was to feel, what people feeling right now, that kind of stuff, I don't know. I don't know what you felt in 2008. I don't know what you felt.
Oh, you should ask some questions.
So I don't I can't go by feeling. But what I could tell you is about
what about 2010? You didn't know that?
I can tell you about the fundamentals, and the fundamentals are things that are driving. I said, you know, I think I mentioned this earlier. I think what first drove the markets, the recent sell-off, was initially the algorithmic trading drove the sell-off. That first big.
So computers. So I had questions about that. Is that still human beings? Are those still human beings? That's
algorithmic trading. I mean, obviously, human beings have to program the computers, but
so
I feel
humans.
Well, obviously, everything is still human, right? It's still human. You create a bunch of stuff, but no, I don't think it's still algorithmic trading. When I say algorithmic trading, I mean a human being did not make that decision to sell things off. It happened because the robot or algorithmic trading.
So I guess I'm trying to distinguish: is it a computer error or it was programmed there?
It was programmed. Because something is programmed doesn't mean it's an error. It could be an error. It might not be an error.
Okay.
But it was due to algorithmic trading. That's what caused that massive sell-off, right? And that could be rightfully programmed and say, okay, now it's time to get the fuck out. Or it could be, okay, let me get the fuck out. But
it wasn't like a surge, like an error like that happened in 2000. What was that, 2010? That came back.
You're talking about flash crash? Nah.
There was a flash crash, yeah.
And that's something you're going to see a lot more these days because of the algorithms trading. But anyway, the point I'm trying to make is this, though. So algorithmic trading caused that initial drop. And after the initial drop came down, people had fear of the market, like, okay, what's going on? And people started taking their losses, taking their profits, whatever gains they had from the past couple of for the rally they had in the past year. Right. Now that sell off from the algorithm led to people taking out their money out of the market, which led to more selling off. And now they also have the quantitative easing, like, you know, Feds. Now, for all fundamentals are coming into play. The Feds, I think they're gonna slowly, or they're thinking about raising the interest rates. And now we also know that that's part of what has been artificially been supporting the market, right? So I don't know if everybody knows that, but that's part of why. So people will say, "Oh yeah, everything's going up, it's going up." Yeah, but obviously the market has artificial support from the federal government. So that's part of why when things move down, you want to pay attention, even if you are playing long term, because back in 2008, everything was going up. Eventually, it came down. So when you're making no highs, you gotta look at that graph like, damn. Where is the next fucking resistance? Because this shit's been running up for a long time, and that's how you lose all your fucking money. So that's why I'm saying that, you know, even if you're playing long term, you wanna hedge, you wanna have an exit strategy, and you still pay full attention.
I 100% agree with edging, wherever that is, and I agree with you that everybody should be watching their money. I agree with you that nobody should be stuck in a bucket.
I said last time, even your boy Warren Buffett said, "Hey, pour your money in one place." I'm gonna say I agree with that and watch it. So even if you're playing long term, you still want to watch it, right? Exactly.
Yeah, you should, especially in this market. There's really no excuse for anybody not to be able to download an app. That was just me giving all the hypotheticals. There's no reason why you can't learn a few things here. Like you mentioned Straddle earlier, which is an option call put strategy, right? Yeah, there's no reason why you can learn a few things here and there and protect your money. There's nothing wrong with even playing a long term like that 2009 run from 17 and seeing that wait, this market has tested a support or sorry a resistance. I think it's gonna let me buy a straddle at this point just to protect against this downside because there's quite a few of those sell-offs and those sell-offs um, can can trigger anything. You just never know. It may not run all the way from 2009 to 17. It may run in a way that because sometimes there will be a sell-off and there will be a second sell-off before it takes off again, and you may decide to sell at the second sell-off. So I think it's a good idea for people to pick up the books and learn a few strategy if you're going to play that game uh long term. And I think if anybody is here watching us, then they have an edge against the rest of the market. I think the rest of the market will always lose money because
Yep, yep.
if everybody was if buying this thing were just good enough, everybody would be making money. So there's always that's why I want to keep doing this too, because there's always something new to learn on any of this stuff. So I strongly agree that yes, edging, which is also looking at the downside of things. We just have one of the companies that I am an affiliate with that actually produce a very nice income for me. FTC just literally shut them off today. They're doing investigations. So I know what I'm talking about when I was talking about what I was talking about last year. You just never know. That's the point. You just never know. It's not a right and wrong thing. You just never know what the hell they're looking at. You just never know what kind of odds are against you because it's a marketplace. There's so many, like you were just telling us about the flash thing just now, and the algorithm, whatever that is, right? Whatever that
Algorithmic.
the algorithm that's selling off those things, right? That's creating a spark that makes people that causes a fear for people to sell off. You just never know when those things are gonna kick in. We don't know what the downside. And the truth is that when everybody is burnt, everybody's burnt. That means including you. So if you learn one or two extra strategies here and there to hedge against that person that says fuck it, I don't want to learn anything, right? Then you be in the upside. So I strongly believe in that. I actually have a book called I think it's called the option by these two gentlemen from CNBC. They wrote like a small book on learning options. If I have a chance, I'll come back and post it back in the
Yeah, so I mean, education is important, man. Guys, if you're here, you're in the right place. So, good thing for tuning in. That's the first step. You got to keep learning. Not just here. If you want to go do some more further research, if some things were not 100% clear to you, ask questions or go do your own research. Find out more about options, how to play them, and how to use them in this marketplace because I feel that they're important, especially now more than ever. Whenever there's uncertainty in the market, you want to take advantage of options. Some other strategies I also use is I do some options selling. And as a matter of fact, that's usually very good and profitable in a market like this when there's a lot of volatility, because volatility is another key component when it comes to the option contract. If you want to, you're a little bit advanced or you do more research, you find that out. And when you're selling these options, you find out by selling options, you're making more money than those who buy because the options have become more expensive. They have a higher premium to them because there's more volatility in the market. Volatility in the market generally goes up when the market is going down, and volatility quiets down when the market is going up. There's a volatility index. It's called VIX. You can look it up.
Right.
When we have this market crash, went down, the volatility index VIX popped right up because generally whenever the market sells off, there's a lot of volatility when it's going down. And when it goes back, market's going up, volatility is quiet. And the past year and a half or whatever, as the market has been slowly creeping up, volatility has been really nice and low. But now volatility is getting angry.
I've always wanted to.
Whenever volatility is going up, that's when you want to sell options so you can get that advantage and that premium. What are you saying?
Sorry to cut you off. I've always wanted to track the VIX. Does the VIX, is it a trailing lag? Does it tell you before I know it measures volatility. You can see spikes in volumes and stuff, or how much stuff is moving out there. And does it give you does it actually tell you upfront? Is it a good indicator that tell you upfront if there's going to be a sell-off like this, or it's just strictly volume?
I mean, it's a good indicator of volatility in general. So if you look at the VIX and how it performs, it definitely tracks. If you look at it right now, you have the graph, you can pull it up. See, the VIX generally tracks to the opposite of how the market is performing. And this, like I said earlier, is because the market generally performs opposite to volatility.
So does it create a good sell signal?
It depends. I don't want to give any ill
It
advice.
depends. It's still by itself. It's probably not good enough. Just by itself, right? It's probably other indicators you got to look at.
No one thing is ever good enough, and that's what makes it to me. That's what I like certain things, and even then, it's not good enough. You want to have certain things aligned before you want to use. You can't just go off one indicator alone. You want to have a couple of things lining up, like the stars align, and once everything lines up, say, okay, this is a good time for me to go ahead and make this trade, buy or sell, or buy a straddle, whatever you want to do. You want certain things to line up. You don't just go by one magic, one glass ball.
I mean, there was a rule of thumb that I came up with not too long ago that I said in every market, it doesn't have to be stock, but anything. You want to always have like this 5 to 7 indicators, and you want 3 of it to be giving you that signal. And even at that 3, sometimes your odds are going to be against you. But obviously, sometimes you're still going to have more losses than win. But when you have those wins, it's going to be good wins, right?
Now, so I mean, it's a couple of ways you could do strategy like that, and that's true. So you could actually have a strategy where, you have 10 things. Say you have a strategy, you have 10 stocks, and 7 of them are winners consistently, and 3 of them are losers. That's fine if everything. If your money spread across evenly, because that way you're gonna make money. 70% are gonna wins, and you're gonna have like 3 losses. So even 60% wins and 4 losses. I don't know if that's consistent the case. Then you're still making money. Now another way you could also have a strategy where you might have like just 2 wins and 8 losses. But the reason that strategy is weighted. You have to have the strategy in a way that those 2 that actually win are they swallow the portfolio all the way, and they eat all the losses, and you make a lot more money. So the different ways you look at it, but at the end of the day, it's all about balancing your wins and your losses. As long as you can consistently make more money, then that's where you want to go. But I think
thanks for telling me that one scenario is not good enough for us to follow you. Should we follow you or not? You want $1 million or not?
That's not what I said. I said that you listen to what I'm telling you, because I call shit before it even happens. That's what I'm saying.
Go on, man. Good conversation, man. Yeah. So thank you, everybody. But bottom line is, we just want people to have some good insights, and we'll create insight and start thinking, start doing their own research, like you said earlier, right? And
I think the bottom line is, if you listen to Nam Diesel, you'll be on your right way. Just listen to what I'm telling you. And if you're tuning right now, you're in the right place. Take notes. Nobody knows everything, but I do know what I'm talking about. We do know what we're saying.
Good.
Follow, like, subscribe, share, do all that, and we'll see you on the next episode.
Good. All right, guys. Thank you so much. See you. Peace.
Peace.